Welcome to the Drowsy Economist. I'm glad you found your way here tonight. This is a space where we explore the structures that shape our economic world, not with urgency or alarm, but with the kind of quiet, unhurried attention that invites your mind to settle. Tonight we'll be moving through the subject of interest rates, slowly, gently, from the most familiar corners of everyday life all the way out to the longer patterns that repeat themselves across decades and centuries. There's nothing here that needs to be memorized. No test at the end. If you find yourself learning something along the way, that's wonderful. If instead you find yourself drifting off into peaceful sleep, that's equally wonderful. There is no wrong way to experience this. And now, let us begin. Most people have had the experience at some point of leaving a small amount of money sitting somewhere and coming back to find it slightly larger. Not dramatically larger, not in any way that changes things in a meaningful sense, just a little bit more than it was before. A savings account, perhaps, that earns a modest amount each month, a number that appears on a statement without much ceremony, added quietly to the total, as though it had always been there. It's easy to overlook. The amounts, especially in certain periods, are not large. A few cents here, $1 or $2 there, the kind of addition that a person could go months without noticing. And many people do go months without noticing because there is nothing about it that demands attention. It happens in the background, like the slow filling of a container left under a drip. And yet, if you were to look at it carefully, if you were to trace that small addition back to its source, you would find something interesting. You would find that the bank or institution holding your money has made a kind of promise. It has said in the language of account agreements that almost no one reads in full, "Leave your money here, and we will pay you a little more for the use of it." That is the arrangement. That is, stripped down to its most basic form, what interest is. The money sits. Someone else uses it in the way that financial institutions use deposits, lending them out, moving them around, putting them to work in various ways. And in exchange for the right to do that, for the time during which your money is not in your hands, you receive a small payment. It is quiet. It is slow. But it is real. Most people encounter this in reverse as well, which is to say most people have also had the experience of borrowing money and paying back more than they borrowed. A car loan maybe, or a student loan, or a credit card balance that was not paid off at the end of the month. The number that comes back is always larger than the number that went out. And the difference between those two numbers, between what was borrowed and what was repaid, is interest, moving in the other direction. This is the same principle, just viewed from a different angle. When you are the one with the money, you receive interest. When you are the one who needs money, you pay it. And somewhere in between those two positions, there is a rate, a percentage, that determines how much. That rate is what we're here to think about tonight, in the calm and unhurried way that tends to make even complicated things feel manageable. It is worth sitting with the basic logic of it for a moment before moving anywhere else, because the basic logic is actually quite simple, even if everything built on top of it becomes more layered over time. When someone borrows money, they are, in a sense, borrowing time. They are saying, "I need this thing now, and I will pay for it later." The lender is saying, I have this thing now and I could use it myself, but I will let you have it in exchange for something extra when you return it. That extra something, that additional payment made in exchange for the delay, is what gives interest its character. It is, at its core, a payment for time. This idea that time itself has a kind of value is one of those observations that feels obvious once you hear it stated plainly, but is easy to pass over in ordinary life. $100 today is not the same as $100 a year from now, not because the money is different, but because having it now means you can use it now. You can buy something with it, invest it, set it aside, let it earn its own small return. Having it later means none of those things are available to you during the waiting period. So when someone asks you to wait, when they ask to hold your money and return it later, they owe you something for the inconvenience, for the time that passed without the money in your hands. That something is interest, and the rate, the percentage, determines how much something. A higher rate means more is owed for each unit of time that passes. A lower rate means less, and the rate that applies in any given situation depends on a great many factors, most of which we will come to in the quieter hours of this exploration. For now, it is enough to sit with the image of two people, one who has money and one who needs it. The one who has it extends it temporarily to the one who needs it. And at the end of the arrangement, whether it lasts a year or a month or 30 years, the one who received it returns it, plus a little more. That little more is the rent paid for the use of the money, just as you might pay rent for the use of an apartment or a fee for the use of a tool. You pay interest for the use of borrowed funds. And just as the landlord sets the rent and you agree or walk away, the lender sets the rate and the borrower agrees or looks elsewhere. The comparison to rent is not perfect, but it is useful. It makes the whole arrangement feel familiar in a way that technical language often obscures. Borrowing money is, in many respects, simply renting it, and interest is simply the cost of that rental, spread out over the period of the loan. There is something almost domestic about it, when you describe it this way. A quiet transaction between two parties based on trust and time. One person has more than they need for the moment. Another person needs more than they have. They come to an agreement. Money moves in one direction, and then, later, it moves back, slightly larger, in the other. This has been happening for a very long time, longer, in fact, than most people realize. Long before banks existed in any recognizable form, before paper money, before coinage, people were lending things of value to one another and expecting something in return for the wait. Grain was lent and grain was repaid with extra. Livestock was lent and returned with interest paid in the form of offspring, born during the lending period. The logic is the same. You borrow something living and productive, and when you return it, you return some of what it produced during the time it was in your care. The ancients who worked out these arrangements were not economists in any formal sense. They were farmers and merchants and record keepers trying to solve a practical problem. The problem of time, the problem of need arriving before supply, and the solution they landed on, pay a little more for the use of what you borrowed, has persisted in one form or another through every economic era that followed. It is, in that sense, one of the most durable ideas in human economic life. Not glamorous, not dramatic, just persistent. The quiet logic of borrowing and repaying, of waiting and being compensated for the wait, running like a steady current beneath everything else. If you have a savings account, you have felt that current. If you have ever taken out a loan, you have felt it from the other side, and in both cases the number that determined how much, that percentage, that rate, was doing its quiet work in the background, the same way it has always done across many centuries and many kinds of money. We will come to understand that rate more fully as the night goes on. How it is set, who sets it, why it changes, why it sometimes climbs to levels that feel almost punishing, and other times falls so low that it seems almost incidental. All of that is ahead, and we will move through it slowly, without urgency. But for now, it is enough to recognize that you already understand the essential thing. You understand it from the savings account statement that arrives quietly each month. You understand it from the loan agreement you may have signed, the repayment schedule laid out in neat columns. You understand it in the way that anyone understands something they have lived with, even if they have never quite put it into words. Money held for a time earns something extra. Money borrowed for a time costs something extra. And the rate at which that something accrues, that is the interest rate. A number that, for all its apparent simplicity, turns out to govern an enormous amount of how the world works. Let us settle in. There is a great deal of quiet ground to cover. There is a particular quality to financial arrangements that makes them feel more abstract than they actually are. The language around them, rates, percentages, terms, principal, yield, tends to create a certain distance between the person and the thing being described. But underneath the language, the arrangements themselves are often quite concrete, quite human even. Consider the act of lending money to a friend, not a formal loan, not a bank, just a person with some money, and another person who needs a little of it for a time. The one who lends thinks, even if they do not say so out loud, I could use this money myself. I could spend it, or set it aside, or do something with it. But I will let you have it instead because you need it, and because I trust you to return it. And the one who borrows thinks, I need this now, and I will make it right later. There is an understanding between them, even if it goes unspoken, that the borrower owes something for the patience of the lender. Sometimes that something is expressed in gratitude, sometimes in a meal paid for, a favour returned, and sometimes in more formal arrangements it is expressed in a number, a percentage, a rate. The formal version of this transaction is, at its heart, the same transaction. The scale is different. The paperwork is different. The parties involved may never meet. But the underlying logic, one party has, another party needs, a rate is agreed upon, and time does its slow work, remains. And there is something worth paying attention to in the phrase, time does its slow work, because this is really what distinguishes interest from a flat fee. A flat fee is paid once, and it is done. Interest, by contrast, accumulates. It grows with time. The longer the loan runs, the more interest builds up. And this accumulation, slow, steady, patient, is one of the defining features of the concept. On the borrowing side, this is what makes long loans feel heavier than short ones, even when the rate is the same. A loan repaid over 30 years will carry far more interest in total than the same loan repaid over 5. even if the percentage charged each year is identical. The time is longer, and so the accumulation is larger. It is not a trick or a distortion. It is simply the mathematics of weighting, applied consistently over a longer period. On the saving side, this same accumulation works in the other direction, to the saver's benefit. Money left in a savings account for many years will earn more in total than the same money left for only a few months, not because the rate is higher, but because more time has passed, more intervals of earning, more small additions. The container, to return to that earlier image, has had more time to fill. This is a feature of interest that people have understood, in practical terms, for a very long time. Leave something to grow and it will grow more the longer you leave it. Take on a debt and it will expand the longer it remains unpaid. These observations are not sophisticated. They are, in fact, quite intuitive, the kind of thing a careful person learns from experience without ever needing to be formally taught. And yet they carry within them a principle that has shaped the way economies function across centuries. The principle that time is not neutral, that a year from now is different from now, in a financial sense, in a way that can be measured and priced, that the distance between the present and the future has a cost or a value depending on which side of the transaction you are standing on. There are older ways of expressing this principle. In various ancient traditions, the idea that money could grow over time simply by being lent and returned with something extra was regarded with a mixture of fascination and suspicion. Some cultures and religious traditions placed restrictions on the practice, particularly when it occurred between members of the same community. The concern was not always about the mathematics. It was often about the relationship, about what it meant socially and morally for one person to profit from another's need, for the passage of time to result in a transfer of resources from one party to another. These concerns shaped the history of lending in ways that are still visible today. If you look at certain parts of the financial system, there are financial instruments and institutions designed, in part, to provide the functions of lending and borrowing without the explicit mechanism of interest, because of traditions that view such mechanisms as problematic. The solutions arrived at are often clever, structured so that the economic function is preserved while the form is altered. The underlying reality, that time has a cost, that deferred use of resources has a price, tends to persist even when the explicit terminology is set aside. But for most of the world's financial systems, interest has been the standard solution to the problem of time, a straightforward and agreed-upon price for the use of money across a period, and the rate has been the variable that captures all the relevant information about that price in a single number. What goes into that number? What does the rate actually reflect? At the simplest level, it reflects what the lender could have done with the money otherwise. If a person could earn a certain return by simply leaving their money in a reliable place, then lending it out requires a return at least as good. Otherwise, there is no reason to lend. The opportunity given up, the other thing that could have been done, sets a kind of floor for what any lender is willing to accept. Then there is the question of risk. Lending to someone who is very likely to repay is different from lending to someone who might not. A reliable borrower, one with a long history of repaying on time, with stable income and predictable circumstances, represents a safer bet. and safer bets tend to attract lower rates. The lender does not need to be compensated as much for taking on a risk that is, in fact, quite small. But a borrower whose circumstances are less certain, whose history is shorter or less consistent, whose future income is harder to predict, that borrower represents a greater possibility of loss for the lender. And lenders in general require more compensation for greater possibility of loss. So the rate goes up, not as a punishment exactly, but as a reflection of what the lender believes they are taking on. This is why the rate offered to different borrowers can vary so widely, even when the underlying economy is the same. A large company with decades of stable operation and reliable cash flows might borrow at quite a low rate because the risk of non-repayment is considered small. A newer business with an uncertain future or an individual with limited financial history might borrow at a much higher rate because the risk is considered greater. The money is the same, the time is the same, the rate is what adjusts to account for everything else. And then there is one more element, one that sits behind all the others and shapes them in ways that are easy to miss if you are not looking for it. That element is inflation, and we will move toward it gently, because it is one of those concepts that sounds more complicated than it is. Inflation, at its most basic, is the observation that prices tend to rise over time. Not all prices, not always, not in every place and every period, but as a general tendency, the things that money can buy become slightly more expensive across the years. A sum of money that could purchase a certain amount of goods in one decade may purchase somewhat less in the next. The money has not changed, but what it can do has changed quietly, in the background. This matters for lending and borrowing because it introduces a subtle distortion into the idea of repayment. If you lend $100 today and are repaid $100 in 10 years, you have been repaid the same number. But you have not necessarily been repaid the same amount of purchasing power. If prices have risen over those 10 years, if the things that $100 could buy have become more expensive, then the $100 you receive back is, in a real sense, worth less than the $100 you handed over. Lenders are aware of this. They have always been aware of it, even in periods when the word inflation was not in common use. The experience of being repaid in money that had lost some of its usefulness was familiar across many eras, and the response to that experience over time was to build an expectation of rising prices into the rate itself, to ask for a slightly higher return, not just to cover risk and opportunity cost, but to account for the likelihood that the money coming back would be worth somewhat less than the money that went out. So the interest rate, even in its most ordinary form, is doing several things at once. It is compensating the lender for the time the money is unavailable. It is accounting for the risk that the money might not come back at all. And it is adjusting to some degree for the slow erosion of purchasing power that tends to happen across long stretches of time. All of this is folded into a single percentage, a number that appears on a savings account statement or a loan agreement without explanation, without any of this context, just a figure sitting quietly next to a balance. And yet behind that figure is a long accumulation of considerations, each one the product of experience and adjustment and the slow working out of how to price something as slippery as time. It is, when you look at it this way, rather remarkable that a single number manages to carry so much, and it is perhaps equally remarkable how little attention most people pay to it. Most of the time, the rate is there, it does its work, and the world moves on. But there are moments, periods in history, turning points in economic life, when the rate becomes very hard to ignore, when it rises sharply or falls dramatically, and its effects ripple out into ordinary decisions in ways that are suddenly quite visible. We will come to those moments, but not yet. For now, it is enough to understand what the rate contains, what it is trying to say in its quiet, numerical way about time and risk and the slow movement of prices across the years. Inflation is one of those words that tends to arrive with a certain weight to it. In news reports, in conversations about the economy, it often carries an edge, a sense that something is going wrong, or has gone wrong, or is about to. But stripped of that edge, stripped of the urgency that tends to accompany it in public discussion, inflation is simply a description of something that happens slowly, almost imperceptibly, across long stretches of time. Prices rise. The same amount of money buys a little less than it used to, and then a little less again. It is not a sudden thing usually. It is more like the way a river changes its course over many years, gradual, continuous, and nearly invisible from one day to the next, but unmistakable when you compare a point far back to where things stand now. Someone who lived through several decades in the same place and bought the same kinds of things across those decades would have noticed it, not dramatically, but in the slow accumulation of small changes. The loaf of bread that cost one thing in one decade and a noticeably different thing 2 decades later. The rent that seemed reasonable at one point and unreasonable at another. These are the traces of inflation, left quietly in the fabric of everyday life. For a lender, this gradual rise in prices is a background concern that never entirely goes away. If you agree today to receive a certain sum of money back in the future, and prices between now and then rise by some amount, then the real value of what you receive, what it can actually be exchanged for, will be somewhat less than what you handed over. The numbers will match, but the usefulness will not, quite. And so lenders, when setting rates, think not just about the nominal return, the raw number, but about what that return will actually mean by the time it arrives. A rate that looks adequate today may look less adequate if prices rise faster than expected. A rate that seemed excessive at signing may turn out to have been barely sufficient. The relationship between the rate charged and the inflation expected is one of the quieter calculations running beneath every lending arrangement, even when neither party names it explicitly. Economists have a way of separating these two things, the rate that is stated and the rate that accounts for inflation. The stated rate, the one that appears in the agreement, is sometimes called the nominal rate, and the rate adjusted to account for the rise in prices is sometimes called the real rate. The difference between them is, roughly, the rate at which prices are expected to rise over the life of the loan. These are useful distinctions, even if they are ones that most people never encounter outside of a classroom or a financial news article. What they point to is something simple, that the number on the page and the actual purchasing power that number represents are two different things, and that over long periods the gap between them can be significant. In periods when prices are rising quickly, Lenders tend to demand higher nominal rates because they know that the money coming back will have lost more of its usefulness by the time it arrives. In periods when prices are stable or rising only very slowly, lenders can afford to accept lower rates because the erosion of purchasing power is less of a concern. This is one of the reasons why interest rates and inflation tend to move in similar directions over time. Not always, not precisely, but as a general pattern that holds across many decades of economic history. It is also one of the reasons why saving in a low-rate environment can feel somewhat futile. If the rate earned on a savings account is lower than the rate at which prices are rising, then the saver is, in a quiet and technical sense, losing ground. The balance grows, but what it can purchase shrinks faster than the balance increases. The numbers are moving in the right direction, but the underlying reality is moving in the wrong one. This is uncomfortable to sit with, and most people, quite reasonably, do not spend much time sitting with it, but it is part of the honest accounting of what interest rates mean in the context of an economy where prices are always, to some degree, in motion. Now, all of this, the rate, the risk, the inflation expectation, the quiet arithmetic of time, has, throughout history, been worked out through a decentralized process. Lenders and borrowers coming to agreements based on local conditions, local knowledge, local trust. In earlier centuries, a merchant in one city might lend to a merchant in another, and the rate would reflect what each party knew about the other, about the distance between them, about the risks of the journey the money would take, about the time that would pass before repayment could reasonably be expected. There was no central authority setting the terms. There was negotiation, reputation, and experience. This worked after a fashion for a long time, but it also produced enormous variation. Rates in one place might be radically different from rates somewhere else, even for essentially similar transactions. And in times of crisis, drought, war, plague, the sudden collapse of a trading route, rates could spike to levels that made borrowing ruinous for those who most needed it. There was no stabilizing force, no mechanism to smooth out the extremes. Over time, as economies grew larger and more interconnected, the idea emerged that someone, some institution, might play a coordinating role, not setting every rate for every transaction, but influencing the general level at which money was lent and borrowed throughout the broader economy, providing a kind of floor or a reference point from which other rates could be calculated. This is the role that central banks came to occupy, gradually and unevenly, across the last few centuries. Central banks are not a new invention, but their current form, as institutions with the explicit mandate of managing monetary conditions across an entire economy, is relatively recent in the long sweep of financial history. And the tool they are most associated with, the one that has become almost synonymous with the idea of monetary policy in the public imagination, is the interest rate. Not every interest rate. Central banks do not set the rate on your savings account, or the rate on a car loan, or the rate your credit card charges on unpaid balances. What they set, or more precisely what they target, is a specific short-term rate, the rate at which banks lend to one another for very brief periods, often overnight. This rate sits at the foundation of the financial system, and from it, like a stone dropped into still water, ripples spread outward to affect a great many other rates. When this foundational rate rises, borrowing throughout the economy tends to become more expensive. Banks that lend to one another at higher rates pass those higher costs along to the businesses and individuals they lend to. Mortgages become more expensive. Business loans carry higher charges. Credit cards charge more on unpaid balances. The general cost of accessing money goes up, and the economy responds slowly and unevenly in ways that ripple through purchasing decisions and investment plans and the quiet calculations of households trying to work out whether to borrow or wait. When the foundational rate falls, the reverse tends to happen. Borrowing becomes cheaper. Money flows more freely. Businesses find it easier to finance new projects. Households find it less costly to take on debt for large purchases. The economy, in theory, picks up some momentum. The central bank adjusting this rate is, in a sense, adjusting the temperature of the economy, gently when possible, more abruptly when circumstances seem to require it. The goal is not to maximize borrowing or to minimize it, but to find a level that keeps the economy moving at a pace that doesn't tip into the extremes. Not so slow that activity stagnates, not so fast that prices begin rising in the unstable and disruptive way that very high inflation produces. It is an imprecise instrument. The effects of a rate change do not appear immediately. They work their way through the economy over months, sometimes over years, through countless individual decisions that no central bank can observe or direct. By the time the effects of one adjustment become visible, circumstances may have changed, and a different adjustment may already be needed. It is, in many respects, less like adjusting a thermostat and more like trying to steer a very large, very slow vessel through water that is itself in motion. And yet, for all its imprecision, the rate set by a central bank carries a weight in the financial system that is difficult to overstate. It shapes the cost of almost every significant financial transaction in an economy. It influences decisions made by businesses, by governments, by individuals with savings accounts and mortgage payments and retirement plans. It sits quietly at the center of an enormous web of financial relationships. And when it moves, that entire web adjusts, slowly, unevenly, but unmistakably. Most people feel these adjustments without being entirely sure what they are responding to. A mortgage that suddenly seems more or less affordable. A savings account that begins earning a little more or a little less. A business decision that felt reasonable at one rate and impractical at another. These are the everyday expressions of something decided in a committee room by people looking at data and models and trying to make judgments about where the economy is going and what it needs. The distance between that committee room and those everyday decisions is what makes monetary policy feel abstract to most people, most of the time. And yet the connection is real. The rate set at the center of the system eventually finds its way to the edges, in the form of monthly payments and account balances, and the slow accumulation of small changes that, taken together, shape the financial texture of ordinary life. There is a distinction in the world of interest rates that tends to go unnoticed in ordinary life, but that shapes an enormous amount of how the financial system behaves. It is the distinction between rates that apply over short periods and rates that apply over long ones, between the cost of borrowing money for a week or a month and the cost of borrowing it for 10 or 30 years. these are not simply the same rate applied to different time spans. They are, in many cases, quite different numbers, reflecting quite different things about how the world is expected to unfold. To see why this is, it helps to think about what a lender is actually agreeing to when they extend money over a very long period. Lending for a week is a relatively contained commitment. The lender gives up the use of their money for 7 days, during which the world is unlikely to change, in ways that would make the original terms seem badly miscalculated. The risk is bounded. The time is short. Whatever uncertainty exists is confined to a narrow window. Lending for 30 years is a different kind of agreement entirely. Over 30 years, prices will change. The broader economy will expand and contract, probably several times. Policies will shift. The financial landscape will look different in ways that are essentially impossible to predict with any precision from where the lender stands today. And all of that uncertainty, all of that exposure to a future that no one can see clearly, is part of what the lender is taking on when they agree to a very long arrangement. This is why, under normal conditions, long-term rates tend to be higher than short-term ones. The lender requires more compensation for committing to a longer period, because a longer period carries more uncertainty. More things can go wrong. More things can change. The rate needs to account for all of that additional exposure, and so it tends to sit higher than the rate for a loan that will be repaid in a matter of weeks. This relationship, short rates lower, long rates higher, is what economists call a normal yield curve. It is not always the shape things take, but it is the shape that feels intuitive when you think it through. Longer commitments, more uncertainty, higher compensation required. There are periods, though, when this relationship inverts, when short-term rates rise above long-term ones, producing a shape that runs in the other direction. These inversions happen for reasons that are not always easy to explain simply. But one common cause is the expectation that rates are going to fall in the future. If enough lenders and borrowers believe that short-term rates are elevated now, but will come down later, they will be willing to lock in long-term rates at a somewhat lower level, because doing so protects them from the decline they expect. And this willingness pushes long-term rates down relative to short-term ones, sometimes below them. An inverted yield curve has historically attracted a great deal of attention from economists and financial observers, because it has sometimes preceded periods of economic slowdown. Not reliably, not as a perfect signal, but often enough that it has come to be watched. It is a shape that suggests something about expectations, about what the people who lend and borrow for a living believe is coming, and what it often suggests is that they expect conditions to ease, rates to fall, economic activity to slow. But this is the kind of nuance that is most interesting to those who spend their days in the details of financial markets. For most people, the simpler observation is enough, that the rate on a long loan is usually higher than the rate on a short one, and that this difference tells a quiet story about time and uncertainty and the cost of committing to a future you cannot entirely foresee. Both rates, short and long, respond to the central bank's adjustments, but they respond differently and at different speeds. The short end of the curve is more directly influenced by the rate that central banks set. When that foundational overnight rate moves, Short-term borrowing costs tend to follow quickly because they are most directly connected to the rate at which banks fund themselves from one day to the next. Long-term rates respond more slowly and more to what markets expect the central bank to do over the coming years than to what it has done today. If lenders believe that a central bank's current rate will be sustained, long-term rates may follow. If they believe the current rate is temporary, a response to unusual conditions that will eventually resolve, long-term rates may move less or move in a different direction entirely. This is part of what makes the management of interest rates more complicated than setting a single number and watching the economy adjust. The system has many moving parts, many rates responding to different pressures on different timescales, and the central bank, sitting at the center of it, can influence but not fully control all of them at once. Across history, these rates have moved through long cycles, not the short, sharp swings that financial news tends to focus on, but the slower, deeper undulations that play out over decades. There have been periods in which the general level of interest rates across an economy was high, broadly, consistently high, for many years at a stretch, and there have been periods in which rates were low, also for many years, also broadly and consistently. The middle decades of the 20th century offer one illustration of this. In many developed economies, the years following the Second World War were marked by a long, gradual rise in interest rates. As economies rebuilt, as populations grew and demanded goods and housing and credit, and as inflation, which had been relatively contained in the immediate post-war years, began to reassert itself across the 1960s and into the 1970s. The rising prices put pressure on rates. Lenders wanted more compensation for the erosion of purchasing power, and central banks eventually responded by pushing rates to levels that would have seemed extraordinary in calmer times. In the United States and in several other major economies, short-term interest rates reached levels in the early 1980s that remain among the highest recorded in the modern era. The purpose was to bring down inflation, which had become elevated enough to be genuinely disruptive, not in the creeping, barely noticeable way that mild inflation operates, but in a way that made planning difficult, that made long-term commitments uncertain, that made the quiet arithmetic of borrowing and saving harder to rely on. The cure was painful in its own way. Very high rates made borrowing expensive, slowed economic activity, and caused real hardship for those whose livelihoods depended on credit. But the inflation came down, and over the years that followed, rates came down with it. What followed was one of the longest declines in interest rates that the modern world had seen. From those peaks in the early 1980s, rates in many developed economies fell, not in a straight line, not without interruption, but steadily, across 4 decades, to levels that eventually approached zero. The reasons for this long decline are still debated, and they are numerous: changing demographics, shifts in global trade, technological change that held down the cost of goods, and various choices made by central banks and governments along the way. But the pattern is clear in the data, for anyone who looks at it. A long arc downward, spanning the careers of multiple generations of economists and policymakers. At the far end of that arc, in the years following the financial crisis of 2008, and again in the years following 2020, rates in several major economies fell to levels that were by historical standards remarkable. Near zero. in some places briefly below zero, meaning that lenders were, in effect, paying for the privilege of holding their money in certain very safe instruments, a situation that reverses the ordinary logic of interest so thoroughly that it is still somewhat strange to describe. These very low rates reflected in part an attempt by central banks to support economies that were struggling. By making borrowing essentially free or close to it, the hope was to encourage businesses to invest and households to spend, to keep economic activity from falling further than it already had. Whether this fully achieved its intended effects is a question that economists continue to discuss. What it unquestionably did was make the experience of saving, in the traditional sense, a somewhat unrewarding one for many years. The saver who placed money in a savings account and waited for it to grow found the growth almost imperceptible. The container was filling, but very, very slowly. And then, in the years following 2020, the picture shifted again. Prices, which had been relatively stable for a long time in many economies, began rising faster than they had in decades. Supply chains were disrupted. Demand, which had been pent up, surged. The conditions that had kept inflation low for so long gave way, at least temporarily, to conditions that pushed it higher, and central banks responding to this began raising rates again, in some cases quite quickly, reversing a significant portion of the long decline in a matter of months rather than years. For many people, this was the first time in their adult lives that interest rates had moved in this direction in any noticeable way. A generation of borrowers had grown accustomed to cheap credit. A generation of homeowners had locked in low mortgage rates without giving the alternative much thought. And then, relatively quickly, the cost of borrowing shifted, and the shift was felt in monthly payments and refinancing decisions and the quiet recalculation of what was affordable and what was not. This is the cyclical nature of interest rates made visible, not as an abstraction, not as a line on a chart, but as something felt in the ordinary decisions of ordinary people. The rate rises, the rate falls, and in the space between those movements, economies and households and individual financial lives adjust, slowly and unevenly, to whatever level the current moment has produced. It is worth pausing here for a moment before moving further into the longer historical sweep, to sit with what that adjustment actually looks and feels like from the inside. Because the cycle described in broad terms can sound orderly. Rates rise, then rates fall, then rates rise again. The economy expands, then contracts, then finds its way back. But the lived version of that cycle is rarely experienced as a smooth arc. It is experienced as a series of individual moments, each one disconnected from the others in the daily texture of life, but connected in retrospect when enough time has passed to see the shape they were tracing together. Consider the household that bought a home during a period of low rates. At the time of purchase, the rate felt simply like the rate, the number that appeared in the paperwork, that determined the monthly figure, that shaped what was within reach and what was not. There was no particular sense of being inside a cycle. The rate was not experienced as temporary or historically unusual. It was simply the condition of the moment, the backdrop against which a decision was made. And the decision was made, and the papers were signed, and the months began to pass. Then rates changed. They rose, as rates eventually do, and the world that had seemed fixed and reliable quietly shifted. Not for that particular household necessarily, Their rate was locked in, their payment unchanged. But around them, for others, the shift was visible. Friends who had been thinking about buying found the numbers no longer worked. Neighbours who needed to refinance discovered that the terms available to them were considerably less favourable than what they had expected. The rate environment had moved, and the effects of that movement were spreading outward through countless individual situations, each one resolving differently depending on the particulars of timing and circumstance and the specific financial arrangements that had been made. This is one of the quieter truths about interest rate cycles, that they do not affect everyone at the same moment, or in the same way or to the same degree. Two people sitting in the same city in the same year with similar incomes and similar financial situations can experience the same rate environment in entirely different ways depending on decisions made months or years earlier. Whether they borrowed when rates were low and locked in a fixed arrangement, or whether they are borrowing now at a higher level. Whether their savings are deployed in instruments that respond quickly to rate changes or slowly. Whether their employer's business model depends heavily on cheap credit or barely at all. The rate is a single number, but its implications fan out into an enormous variety of individual circumstances. There is also a temporal asymmetry in how rate changes are felt. When rates rise, the effects tend to arrive relatively quickly for those taking on new debt, and more slowly for those whose existing arrangements insulate them from the change. When rates fall, the benefits are similarly uneven. Those able to refinance can capture the new conditions promptly, while others remain tied to older, higher rates until their existing arrangements run their course. The cycle, in this sense, is never experienced cleanly. It is always arriving in fragments, reaching different people at different times, layering its effects across a population in ways that produce an uneven and complicated picture when you try to look at all of it at once. From the inside, each period feels somewhat unique. The reasons for the current level always seem particular, tied to specific events, specific pressures, specific decisions made by specific people, responding to specific circumstances. And they are, in part, all of those things. But when you step back far enough, when you look at the longer record, a kind of rhythm becomes visible. Not a precise rhythm, not one that repeats in exactly the same form or on a predictable schedule, but a recognizable alternation between periods of tighter and easier credit, between eras when borrowing is costly and eras when it is not. Historians of finance have traced versions of this rhythm back a long way, not always in the form of explicit interest rates, which require a certain level of financial infrastructure to exist, as formal, quoted numbers, but in the broader pattern of credit conditions, whether money was easy to obtain or difficult, whether lenders were cautious or generous, whether the general terms of borrowing favoured those who had funds to extend or those who needed them. In medieval Europe, for instance, the availability and cost of credit varied enormously by place and period. In times of war or famine, when the risk of non-repayment was high and the supply of available funds was constrained by general uncertainty, credit was scarce and the implicit cost of obtaining it was high. In more settled periods, when trade was flourishing and the movement of goods across distances created a steady demand for short-term financing, credit flowed more easily and the terms were more favourable to borrowers. The underlying mechanism was not so different from what central banks manage today, even though the institutional structures were entirely absent. Supply, demand, risk, and the expectation of future conditions doing their quiet work in the background. The development of more formal financial systems, merchant banks in the Italian city-states, the early public banks of Amsterdam and Stockholm, eventually the great central banks of later centuries, did not change this underlying dynamic so much as it organized it, put structure around it, created institutions that could smooth some of the extremes, that could serve as a reference point for the countless transactions happening at every level of the economy. But the rhythm persisted, easy periods followed by tighter ones, generous credit followed by its contraction. The cycle running on in one form or another, regardless of what institutional arrangements were in place to manage it. Part of what drives this rhythm is the nature of borrowing itself. When credit is cheap and available, more people borrow. Businesses take on debt to expand. Households take on debt to buy homes, to purchase goods that would otherwise require years of saving. Governments borrow to fund projects and services. The economy, in aggregate, takes on more obligation. And for a time, this tends to work. The borrowed money is spent and invested, and the spending and investment generate activity that makes it easier to service the debt. Growth happens. Things feel good. But the accumulation of debt also creates its own pressures. As more borrowing occurs, the demand for loanable funds increases, and rates tend to rise in response to that demand. Rising rates make the cost of carrying existing debt higher, and the terms for new debt less attractive. At some point, the borrowing slows. Businesses that expanded begin paying down what they owe rather than taking on more. Households that stretched to buy homes at the peak of easy credit find the monthly payments a heavier burden as rates move. The aggregate level of new debt creation falls, and with it the momentum that the borrowing had been generating. This is a simplified version of a dynamic that plays out in complex ways across many layers of an economy simultaneously, but the basic shape is recognizable. The very conditions that cheap credit creates, the expansion, the increased activity, the rising demand, tend, over time, to generate the pressures that push rates higher and eventually bring the cheap credit period to an end. And the conditions that high rates create, the slowdown, the reduced borrowing, the cooling of activity, tend over time to create the conditions under which rates can fall again. There is something almost mechanical about it, described in these terms. A system that contains its own corrective tendencies that generates the seeds of its own reversal. And while the real world is considerably messier than this description implies, the timing is uncertain, the reversals are uneven, external shocks can accelerate or delay the cycle in unpredictable ways. The general pattern has been durable enough that it has been observed and remarked upon for as long as people have been paying careful attention to financial conditions. For someone who saves, these cycles have a particular texture. In the high-rate phase, saving is rewarded. The return on a deposit account or on a safe bond is meaningful. The patient accumulation of funds earns a real return, something above the rate of inflation, something that represents a genuine increase in purchasing power over time. There is a certain satisfaction to that, the sense that the discipline of setting money aside is being recognized and compensated in a tangible way. In the low rate phase, saving in the traditional sense yields very little. The account grows, but only by the thinnest of margins, and the saver who wants any meaningful return has to look elsewhere, to assets that carry more risk, to investments that might grow but that also might not, to arrangements that suit a different temperament and a different tolerance for uncertainty. This is one of the ways that the rate environment shapes not just financial decisions but the financial culture of a period. Who is rewarded? Who is not? What strategies feel viable? What feels pointless? For someone who borrows, the cycle runs in the opposite direction. High rates are a constraint. They make large purchases more expensive to finance, make business investment harder to justify, make the repayment of existing debt more burdensome. A mortgage taken out at a high rate represents a very different monthly commitment than the same mortgage taken out at a low one, and that difference shapes what is affordable, what is not, and consequently what gets built and what does not, where people live and how, what businesses can expand, and which ones find the cost of capital too steep to make the numbers work. Low rates, by contrast, open possibilities. They make things financeable that were not before. They lower the threshold for investment decisions, for expansion plans, for the purchase of homes and equipment, and the various large commitments that require borrowed money to complete. There is a loosening quality to a low-rate environment that is felt across many levels of economic life simultaneously. A sense that doors are open that were recently closed, that plans that seemed impractical have become practical, that the cost of reaching for something is lower than it was. Neither phase is without its complications. The high-rate environment, while it rewards saving and punishes reckless borrowing, can also slow things down in ways that cause genuine hardship. Businesses that cannot afford to invest, workers whose employers are contracting rather than expanding, home buyers priced out of markets by the elevated cost of financing. The low-rate environment, while it encourages activity and rewards those who borrow to invest, can also produce its own distortions, asset prices that rise faster than underlying values justify, debt levels that accumulate to the point of fragility, the saver who is quietly penalized for having been prudent. These complications are part of why the management of interest rates has always been contested ground, not just technically, in the sense that it is difficult to know exactly what level is appropriate at any given moment, but politically and socially, in the sense that different rate levels benefit different groups and burden others. The saver and the borrower experience the same rate from opposite positions. The established homeowner with a fixed mortgage and the first-time buyer trying to enter a market feel the same rate in entirely different ways. What appears from a distance as a single number is, up close, an enormous variety of individual experiences, each one shaped by the particular circumstances of the person living it. Central banks navigating all of this set their rates by looking at aggregates, broad measures of inflation, of employment, of economic output, of financial conditions generally. The individual experiences are not invisible to them, but they cannot be the primary input into decisions that have to account for the whole. This is one of the enduring tensions in the management of monetary policy, that the instrument operates at the level of the system while the effects are felt at the level of the person, and what looks like the right adjustment from the aggregate view may look very different from the ground. This tension is not new and it has not been resolved. It is, in a sense, built into the nature of the tool, a single rate, radiating outward through a complex economy, producing effects that are broad and general, but experienced in ways that are specific and particular. The household that sees its savings finally earning something meaningful. The small business that finds the cost of its line of credit has risen past the point of comfortable management. The government calculating what it will cost to service the debt it has accumulated over the years of low rates, now that those rates have shifted. All of them living simultaneously inside the same rate environment, each one feeling it from a different angle. What persists through all the cycles, through all the phases of tightening and easing, through the long decades of decline and the sharp corrections of rising. What persists is the underlying logic. The rate, whatever its current level, is still doing the same thing it has always done. It is pricing time. It is putting a number on the cost of having money now rather than later, of waiting rather than acting, of lending rather than holding. That logic has not changed. The number changes, the conditions change. The institutions managing it change in their structure and their mandates and their tools. But the essential transaction, one party extending to another across a span of time, for a price, remains what it has always been. It is worth returning near the end of this exploration to something simple, to the image of two people or two institutions or a person and a bank come into an agreement about money and time. One has it, one needs it, a rate is settled upon, and then time passes in the way that time always passes, steadily, without hurrying, without any particular regard for the financial arrangements made within it. This image, stripped of all the surrounding complexity, is the one that sits at the center of everything we have covered tonight. The rate cycles, the central bank decisions, the difference between short maturities and long ones, the way inflation shapes the real value of promised repayment, all of it is, in some sense, an elaboration of that one basic arrangement. The details accumulate, the institutions grow more sophisticated, the instruments multiply, but the core remains recognizable, something that a farmer lending seed grain to a neighbor in an ancient river valley would have understood without explanation. There is a kind of comfort in that continuity if you let yourself feel it. The financial world can seem, from the outside, like a place of endless novelty and complexity, where new instruments and new risks appear faster than anyone can track them, where the rules shift and the participants multiply and the technology accelerates and the whole enterprise grows ever more elaborate and ever more difficult to follow. And in some ways that is true. The surface of financial life has changed enormously and continues to change. But underneath that surface the logic is old. Money crosses time. The crossing has a cost. The cost is called a rate, and the rate reflects, always, in every era, in every instrument, some combination of how long the crossing takes, how uncertain the journey is, and how much the destination might differ from the departure point in terms of what money can actually buy when it arrives. The relationship between interest rates and borrowing and saving has a way of fading into the background of daily life until something shifts it back into view. A statement arrives showing that the savings account has earned more than it did in recent years. A letter arrives about a change to the terms of a loan. A monthly payment is recalculated and comes back slightly different than it was before. These are the moments when the rate becomes visible again. When it steps out of the background it usually occupies and makes itself briefly apparent, before receding once more into the ordinary texture of financial life. And then there is the longer visibility, the kind that comes from living through a full cycle, or most of one, from borrowing at one level of rates and watching them shift, from saving through a period of high returns and then watching those returns diminish, from experiencing in one's own financial life the same broad arc that shows up as a line on a chart spanning decades. That kind of visibility is harder to come by because it requires time. More time than most people have had occasion to observe deliberately. But for those who have lived through enough of the cycle to feel its shape, there is something recognizable in all of it. A rhythm, imprecise but real, of tightening and easing, of constraint and release, of the cost of money rising and then, in time, falling again. The rate that exists right now, wherever this moment falls in that long cycle, is the product of everything that came before it, of decisions made in committee rooms and trading floors and government offices across many years, of inflation that rose and was brought down and rose again, of growth that was encouraged and occasionally of growth that was deliberately slowed, of the accumulated experience of institutions that have been managing these questions for generations, and of the theory built up by economists trying to understand what they were observing. It is not an arbitrary number. It is not a simple one. It is a number that contains a great deal of history compressed into a percentage, sitting quietly on a statement or an agreement or a screen. And whatever that number does next, whether it rises further or holds or begins the long process of coming down again, it will continue doing what it has always done. It will price time. It will shape the decisions of lenders and borrowers, of savers and spenders, of businesses deciding whether to expand, and households deciding whether to buy. It will move through the economy slowly in the way that all large things move, not in a single wave, but in countless small adjustments, felt at different speeds and in different degrees by everyone inside the system. This has been a long and unhurried walk through one of the quieter mechanisms of economic life. We have moved from the familiar, the savings account, the loan, the small addition that appears each month without ceremony, through the layers that give the rate its meaning and its complexity, through the history that shows how that meaning has been worked out and reworked across centuries, and back again to the simple logic at the center of it all. If you have followed some of it and drifted through other parts, that is as it should be. Nothing here required your full attention. The ideas will still be there in the morning, patient and unchanged, as they have always been. Interest rates are not urgent. They do not demand anything of you tonight. They are simply there, operating in the background, doing their quiet and persistent work. Somewhere right now, a balance is accruing a small return. Somewhere, a repayment is being made that includes a little more than was originally borrowed. Somewhere, a central bank is reviewing data and considering whether the current level is still the right one, whether something in the economy has shifted enough to warrant a change, whether the long arc is bending in a new direction. All of that continues steadily, whether we are thinking about it or not. This has been The Drowsy Economist. Quiet mechanisms, long cycles, the patient arithmetic of time. If you found value in this gentle exploration, whether for understanding or for sleep, please consider subscribing to the channel and leaving a like. It helps others find this quiet corner of the internet. And if there are other topics in economics or finance you would like explored in this format, the comments are always open. The interest rate that exists right now will continue its work through the night. Loans will accrue, savings will grow by small fractions. The rate set somewhere at the center of the system will remain where it is until someone decides it should move. And the long cycle, the one that has been running in one form or another for as long as people have been lending and borrowing and waiting for money to return, will continue along its unhurried path, indifferent to the hour, indifferent to whether anyone is watching. Thank you for spending this time here. Whether you are still with me or have long since drifted off, I hope you found the rest you came for. Sweet dreams and good night.